Welcome everyone to today's webinar on USD-based life cover. I'm your host, Mrs. Carmen Hachandi, Managing Director at Carrick, Zambia. I'm excited to connect with you all across Africa as we navigate the complexities of financial planning and protection. It is essential to consider the unique needs of and challenges of our continent, Africa. These are constant currency depreciation, high levels of inflation, and political risk. In today's uncertain world, having a comprehensive life cover in place can provide peace of mind and financial security for you and your loved ones. With a USD-based policy, you can enjoy the benefits of a stable and globally recognized currency, protecting your assets and your legacy. Over the next hour, we'll explore the advantages of USD-based life cover, how we can help you navigate or achieve your goals for investments, and also provide insights on current market trends and opportunities. Our goal in this meeting is to empower you with the knowledge and tools you need to make informed investment decisions. So let's get started. For our audience, I draw your attention to your screen, the questions tab. You are free to post your questions as you feel along the presentation. Our discussant today is Mr. Richard Williams, Senior Vice President of Continental Financial Services in Geneva, whom we work closely with to bring the services to your doorstep. Over to you, Richard.
Carmen, thank you so much. What a lovely introduction, and it's so lovely to spend a little bit of time with you, and my thanks to Carmen and Simone for organizing today. It's a thankless task organizing these things, but I'm so thrilled to be here and thrilled to be with Carrick Wealth once again on one of your amazing webinars. I think we've got questions coming in at the end, and hopefully over the next hour or so, I will be able to help some of your people that are tuning in today. So thank you. I should start, if that's okay, a very young picture of me. I think that was taken about 2016. But a little bit of background about myself as a consultant to help support Carrick Wealth. I've been in the industry since 1987, far longer than I care to mention, primarily as a wealth manager for Lloyds Bank, but latterly with Scottish Provident and a few other companies as well. All international. I've lived in Jersey, in Dubai, and in Cape Town, so I'm very familiar with the African market. In fact, I was in Zimbabwe last week, and I have been going to Africa for the last 31 years. Life insurance is a very dull subject, and my mother doesn't get very excited when I tell her what I do. But when we actually unravel the importance of life insurance and the way and the complexity of how this works, I hope that those that have taken time out and do appreciate that to tune in today, you will be very, very enlightened by the way in which it operates. A little bit, if I may, about Continental. We are an international consultancy. We have many facets, but in the context of today, I want to just reassure you and that you're very much in the right hands working with Carmen at Carrick Wealth, because we have access to an unlimited amount of solutions around the world, so we can help Carmen and her colleagues find the right solutions for clients. We have operations in the UAE, in Switzerland, where I'm officially based, in Hong Kong, Mauritius, and in India, and we've been going for the best part of 30 years. Along with that, we have a lot of experience behind the scenes. We have a dedicated team. We provide product training, but more importantly, we provide support. And that indirectly will affect you, because we can support Carmen and her amazing colleagues, both on the sales side, but also in the administration side, meaning that if her clients want to go ahead with what they see, whether it's this or something else, we can make sure we can get it done quickly in order to get people the cover that they want. So we have an atmosphere of togetherness, of support, of being as communicative as possible throughout the whole way, and we work as a team with Carrick Wealth very, very closely. Within my team, I have a fantastic range of people, and the top right there is Mr. Ashok Sadhana, who started Continental and is a personal friend of mine for the last 30 or so years. And Ashok came into the industry 40 years ago. So again, you are in very, very capable, well-informed, experienced, and professional hands working with Carrick, with Continental backing up and providing the support you need. So that said, we're going to talk today about US dollar life insurance today, and particularly universal life. And I'm going to talk about that and make a few references to other forms of insurance, because I think generally insurance, as I started out with, is seen to be quite a dull and perhaps even boring subject. So we'll talk about what is it, who is it for, who are the solution providers or the product providers, and more importantly, how does it work? But I think before we start all that, let's just reflect on what's going on in the world and what has been happening over the last 3 or 4 years. And not to mention, we've had a global pandemic. And I think part of that has made people realize that irrespective of their health or their wealth or where they live, we've all been a bit susceptible to coronavirus. We may have even lost people or had coronavirus ourselves. I certainly have a friend of 55 years old who passed away, leaving wife and children. And I think this brings to the forefront our own mortality and the fact that ultimately we're passing through this world. Whatever our religion may be, no one gets out of this world alive. We just don't know when it's going to happen. And more the importance, therefore, to have some sort of protection plan in place and have a whole of life plan that we know is not going to finish, so that in essence, Freddie Mercury was right when he said the show must go on, irrespective of what happens. And those of us that are happily married, we all made a commitment to having to hold from this day forward in sickness and in health till death do us part. So really what we're wanting to do here is establish a mechanism whereby life can continue as normal as possible. I hope if I predecease my lovely wife Claire, that she'll raise a glass the day after, but carry on with her life. And these schemes that I'm going to show you allow you to do just that, which is brilliant. Insurance. Yes, it's an interesting topic. And then the great thing, going to the last point there, it's something that doesn't have to be sold to people. It's bought. Man meets woman, they get married, they have a baby, they have 2 babies, and suddenly they've got a lot of responsibility on their hands. They need to make sure that life can continue. In the same way, they need to make sure the electricity works and the water works and the tiles on the roof aren't cracked and their roofs won't leak. It is, in effect, a utility. And it's risk management, because as far as the insurance companies are concerned, if you have 100 people in a room that are insured, if one of those people passes away, and they will at some stage, 100% of their life is over. But for the insurance company, they've only lost 1%, because 99% of the others are still alive and paying their premiums. So all we're doing here, and we're talking about here, is we're transferring that risk management away from someone with deeper pockets than you or me, and in such a way, making it happen efficiently and smoothly. It's a moral obligation to have insurance. So let's just go to the next slide. What is it? Okay, so what is universal life? Is it an investment? Well, it is to a certain extent. Is it a protection plan? Yes, it is a protection plan. But actually with universal life, it's a lot different. It's a multifunctional solution. It's doing lots and lots of different things, offering both protection over the long term, whole of life term, as well as growth opportunities. And I'll talk about that as well, interestingly, whilst managing negative volatility. Volatility just now is a big hot topic. We've got a lot of things going on here and now, right now. We're just over the pandemic, as I mentioned. We've got the situation that remains unresolved in the Middle East between Israel and Palestine and Gaza. We've got what's going on in Ukraine with Russia. We've got presidential elections. We've even got prime ministerial elections in the UK. So lots of things are happening that create volatility in the markets. And if you're bringing volatility into a protection plan, that's not a good thing. So I'm going to show you how this works and how it works differently to any preconceived ideas that you may have had already. A whole of life solution simply means it's going to pay out at what point you die in your life. And these plans actually cover you to 121. And with the greatest of respect, you're probably not going to make 121. What I love is these plans are available in over 150 countries. I'll tell you a very, very quick story, if I may. I was sitting many early 90s in a hotel in Nairobi, and I was speaking to a very young couple, local Kenyan lady and a good-looking dude from the UK, and they wanted to have life insurance, and did their savings plan for them, their investment plan, and we got to the subject of life insurance. And the shame I carried, because it later transpired I could cover him, British guy in Nairobi, but not her, a local lady in Kenya. And that stuck with me. And what I love about what I'm going to show you now is the fact that it doesn't discriminate between anyone's race, color, or creed. It's where they live. That's it. So if you have a Richard Williams equivalent local in Nigeria, exactly the same as me, the price will be the same because we live in Nigeria. And that's a good thing. Now, minimum levels of protection, everything's dollar-based, is $1 million. So this, as we will go on to see, is not for everyone, but it is for a certain criteria of clients around the world. And of course, if you smoke, please don't smoke. It'll cost you more. And smoking is also the same category as vaping, chewing gum, shisha, pipes, cigars. So unfortunately, that has a lot of cost, not just the cigarettes you buy from the corner store. I've gone 2 slides there. Let me go back one if I may. So who is it for? What sort of people would be appropriate for universal life? High net worth individuals, rich people. It keeps rich people rich. People that own their own businesses. So they want to make sure, as the example I'll show you today, that their business can continue if they're not in this world anymore. Families with illiquid assets. Why should a family have to cash in a lovely home that's been in the family for generations because the husband or the wife have passed away? By setting up an insurance plan as one I'm going to show you, it just means that doesn't have to happen. It might happen because they might want it to happen. I've often said to my wife, if one of us was here, would we want to live in the house we're in just now? We're out in the country, and the answer is probably no, but I'd like to have that choice. And then people with global property portfolios. Again, why should you have to sell something at the moment of your grief just to pay for any bills and to carry on with life? So this ensures that you don't have to do that. In terms of why would I use this, a universal life versus other things, it's to keep the family intact, allow the business to carry on, plug in any retirement shortfalls, because as well as the protection element, there's an investment element along the way as well, and I'll show you how that works. Estate planning, making sure intergenerational wealth passes smoothly from the next to the next to the next. You don't want hassle further down the line. You can dip into the accumulating pot of money for educational costs. It's essentially for legacy and succession planning, but you get the idea as we go down that long list. Key person protection, again, you might have 2 directors running a business, and one director may pass away and his widow comes along and says, I want my half of the business. Whereas the existing director says, I want the business to carry on. I don't want to sell the business just because he's died. So it allows some breathing space, a big payout to the business so the business can pay off the grieving widow, quite rightly, but also have money to ensure the business can continue, that the creditors won't come looking for their money, that the competitors won't come stealing clients, and most importantly, that the clients will stay. So maintaining that business continuity is very, very important. So Who are the solution providers, the product providers? And I use the word solution because it is a solution. And principally we have two. These are both Canadian companies, well established. Let me ask you a question. Why would you go with a company that no one's heard of, that's been on this planet for 10 years, when you can go with the biggest and the best, when you can go with Fortune 500 companies, when you can deal with companies that have proved their worth probably before your parents were even born? So we deal with the biggest and the best. So how does it work? I want to pause and ask you to remember one thing here. I want you to replace the word premium in your mind with the word working capital. The reason being, if I insure your car for $300 in a year, and with God behind you, you don't crash the car, your car is intact and you didn't make a claim, great, but you just lost $300. So I need another $310 next year because the price has gone up, and I'll do the same again. Premium subliminally, without us even thinking about it, has the word cost associated with it. And here, all that's happening, you're putting the money, the premium, the working capital, into a central pot, which is called the account value, if you can read that clearly, which is in the middle. And from there, we've got the cost of insurance. That's physically insuring your body in whichever country you're in, let's say Zambia, to ensure that a payout will happen in the event of your death. Here's the bit that's interesting. We're getting to the interesting bit now. The working capital, what's happening with the growth? And essentially what's happening is we're getting growth achieved by tracking an index. And in the example we were using today, that index is called the S&P 500. And there's nothing clever about me, it's just this is all I talk about every day. So essentially, our S&P 500 was launched in 1957. It's had a performance track record of around 9% on average since then. So it's achieved some great growth over that time. But there's been a few dogs, there's been a few years that haven't performed, bearish years. So what happens here is we capture the upside of the good years, but we protect the policy from the bad years. And how do we do that? Well, very simply, the insurance company will be tracking as opposed to investing into that market. So they will look at the date, and today's date is the 31st of May. So on the 15th of June here, they will say, what did the S&P 500 do from the 15th of June 24 to the 14th of June 25? That is called a segment. And whatever the S&P does, they will add that to the bucket, allowing this continuation of cost of insurance to be paid. And also, a client may decide to pay in only for 15 years and then stop paying in, but he's still or she's still covered for the rest of their lives whilst managing negative volatility. Everything is written into the framework of a trust arrangement. I have a friend, a very good friend, whose husband passed away. He had 2 insurance policies. I won't tell you where he is, but you might, because you might have heard of him. But he had 2 insurance policies. One was written in a trust and one wasn't. He died on the squash court at the age of 42. The policy that was written in trust paid within a month. And last time I spoke to her, which was about 2 years ago, which was 2 years after he died, the other policy had not paid out. The best policy is the one that pays out the most to where it's needed the most as quickly as possible, so that life can carry on. And it's as simple as that. These plans come with what's called a master trust. The master trust is free, and it simply is a mechanism within which a client will elect their primary, for me it's Claire, my wife, or their secondary beneficiaries, Esme or Matt, my children, so that in the event of Claire and I dying together, the insurance company will know where to pay the money. And here's the thing, probate is not required. And therefore that makes it easy. Whereas a will can be contested, a will can be challenged, a will can take years to unravel. And believe you me, I've seen that happen. Here, you'd be looking at a payout within about 30 days so that it can get to where it needs to be quickly. Now, we're going to look at the Solus plan specifically and how that works. And that's an offering by Sun Life, and they're based in Bermuda for their international base. Again, we've discussed how big they are. And we're going to look at the investment component, and specifically we'll look at the two on the left, the ultimate account and the balanced account. They both do exactly the same thing, but there are some different characteristics of each. Now, I always go for the balanced account, and let me tell you why. Because when I produce an illustration for Carmen or one of her colleagues, I use a growth rate of 6.39. In other words, I'm saying, what will my premium, my working capital, be if I have a growth rate of 6.39% per year? We know that's well below what the market has actually achieved, but better to be conservative. I'm a Scottish guy. You wouldn't know by my accent, but I'm a Scottish guy by birth. So I'm a conservative chap. I don't want any surprises. Similarly, I'm sure Carmen doesn't want to over exaggerate any expectations, saying, you know, we should do 9, we should do 10. No, trim it back to just over 6%. We can see 100% is invested or tracking the S&P 500. My downside is fully protected, so when my market goes up in that segment, remember, I make money, and when it goes down, I'm protected. I'm not going down with it. Whereas if you have an equity portfolio and the markets go up, great, you make a lot of money, but when they go down, not so great. You lose a lot of money. That can't happen here. What does this mean? Upside market cap. That means if a market goes up in a year by 15%, you will get 10.25 added to the bucket that was in the middle of that diagram. But conversely, if it goes down by 15%, you won't go down. In fact, you will accrue 2% as we go along the way. Now, just touching very quickly on the other account is the ultimate, and you'll see my illustrative rate there is 7.31. You may disagree with me, which is absolutely fine. I feel that 7.31 is a little bit too high for an illustration. I like to manage expectations, but if it's 7.31 by default, that brings down my premium slightly, very, very slightly. My upside cap is slightly higher at 12.25 there, which you can hopefully see. Timing is everything. Think to yourself, when is the best time to set up an insurance plan? Well, it's actually yesterday. The younger you start, the less expensive it is, and the more easy it is to get insurance, because how many people, for example, went to Lehman Brothers in 2007 and it was just another sunny day in New York and they had their Starbucks and they went to work and they came out with a cardboard box because Lehman's had gone under. And that was the beginning of the financial crash, driven by equity problems on property that gradually circled the world. How many of those people became uninsurable because they may have been in their 50s or their 60s, having worked there for their entire lives with a death in service plan? Great, you've got death in service, but the key word is in service. If they're not in service, they're not covered. And in the meantime, they may have become uninsurable, whether it's cancer or whatever it may be. One thing is for sure, from statistics, they would be more expensive to insure. So the earlier someone starts, the better. So meet Pete. Pete is an MBE. He's not an MBE, he's a master brewer extraordinaire. And he works with his two sons, Ollie and George, both of whom are 30 years old, for convenience sake for me doing the numbers. And Pete wants to ensure that in the event of his demise, he's 55, he will be able to make sure the business, his craft brewery, can carry on. And in the same way, he wants to be able to gift something to his children later in life. But he also wants to make sure that the children, not so much children, his elder sons, are also covered. And in doing so, make sure that if one of them dies, the business also has the option to continue. And as such, he sets up a plan. And this is today's example, and I'm not going to bombard you with lots of figures other than here. So I'm going to use my mouse, if that's okay, and you can see here we've got Pete on the left-hand side, and he's 55. he's insuring himself for the rest of his life for $2 million. And he's got the money. So he's paying with a single premium because it would be more expensive to pay over 10 years, but he's got the money. And he's moving it from one pot to another. So his premium he needs to pay is just over $500,000. So it's not a crazy premium. It's he's putting the money from his bank account into the policy, and in return, he's covered for the rest of his life up to, for $2 million. And you can see here the accumulated cash values that I would have from the illustration I would have supplied for Pete at a growth rate of 6.39, which you can see with my cursor here. After 10 years, having been insured for $2 million, Pete's policy is now more than he put in, and he's still insured. When he's 75, after 20 years, he's well in profit. He's $794,000 at a growth rate of 6.39%. Now, that's not the plan growing by 6.39%, that's the S&P moving at 6.39%. But in essence, what that's allowed him to do is secure his business. And then it does what's called endowing at age 100, so it's $2 million. So hang on a sec, it just got interesting because we've got him insured and we've got growth and we're getting our $2 million back as an option if he wants to have that in later life. But he may say when he's 85 in year 30, I don't need this anymore. I feel the business is in safe hands. I've got a policy that's accumulated $1 million or just over $1 million. I kind of think I can gift this money to my children who are older, or even my grandchildren, to help them on the property ladder, for example. The guaranteed bit is saying this. So, Pete, your policy will guarantee you $2 million of cover until you're 77, even if the market goes down consistently for over 2 decades. Now, the chances of that happening are 0. We'll see some good years and some bad years, but we won't see 1 decade and we won't see 2 decades of negative market. But it gives that surety that even in the worst case scenario, you're covered. And if we saw positive years, that age 77 will go to 78 and 79 and so on, so on, so on. Now let's look at the children, not kids. 30, $2 million of cover, you get the idea. But in this case, rather than a single premium, they're paying in over 10 years. So an annual premiums, annual only, of $23,000, just over $23,000. So capital outlay is $237,000. It's a lot of money, I know it is, which is why it's for high net worth individuals. After 20 years, when they're 50, we can see their money has completely been recouped at a nominal growth rate of the S&P of 6.39%. So what we're doing, we're making that premium work. We're covering Pete, George, Ollie to the tune of $6 million. These are for Zambia, these figures. And in so doing, securing the business, securing their families, making sure they have options, and growing behind the scenes in value and protecting from the downside of the market. So looking back, the beauty now, next slide, is the business is in safe hands. The business can carry on no matter what happens, giving Pete, Ollie, George choices. So the business will change when they want it to change. $2 million will be paying out to Pete as and when he passes. $2 million each for George and Ollie for the rest of their lives. And in 20 years, a total capital outlay there of just over $1 million will be worth just over $1.3 million. No more money to be paid into the plan, and it carries on to grow and grow and grow at a nominal growth rate along the way. In terms of what we need when we're working with Carmen to get illustrations for you or your loved ones, it's a case of establishing a number of things. So name or initials, I totally respect any confidentiality, and a lot of people ask for illustrations by initial, and we get that, it's fine. the level of cover required, remembering this is $1 million policy or more. The largest case I'm aware of that's been written of universal life for an individual is $258 million. The largest case we've done is about $120 million. The capacity for someone like Zambia was probably somewhere in the region of about $55 million. Date of birth, essential. The younger you start, the less expensive your premium is. And then we need to have the gender of the client. Women live longer statistically than men. Where a client lives and their nationality. And do they smoke or vape, or chew gum or have a patch? Vaping, can you believe that? That is considered to be smoking. And importantly, any pre-existing conditions. Someone might be diabetic or have hypertension, or they may have had a stent fitted 5 years ago. I know of clients who have had serious, very serious medical conditions during their actual medical examination, because part of the process in setting these plans up are made of 4 different things. So we're looking to analyze someone's health, medical, locally in Zambia, their wealth, their financial background for financial underwriting, their lifestyle. What do you get up to at the weekends? Do you chill out and watch Netflix, or do you go skydiving? And then their professional journey. How do they get to be a CEO of ABC Bank or whatever it may be? And last but not least, how is someone going to fund this? How are they going to pay in their premiums? Is it like Pete? Is it a single premium? Or is it like George and Ollie, where they're going to pay over 10 or 15 years or something like that? And from that, I'll be able to produce a very nice illustration, ensuring that we have everything covered very nicely. Along the way, we have a defined business sales process for our partners, and I'm not expecting you to read all this. I just want you to know it exists. In other words, we have specific events from booking medicals, from gathering all the information, very thorough, very, very thorough. And Carmen will smile. There is a lot of paperwork, Carmen, isn't there? But let me ask you this question. Is it better to be thorough while the client has a pulse, or ask a million questions that we didn't ask prior to his grieving wife or widow? So I'd say it's important to do the former. So we gather that information together so we can make that happen. So that, my friends, on 34 minutes, we're ahead of time, is the way in which universal life works. And it's not difficult. It's very, very straightforward. It is an amazing concept that for the right person means that they can have cover for the rest of their lives. They can have it with the biggest and the best companies. They can have growth following one of the most respected indices in the world, and all the while protecting their families and protecting the downside when markets do not perform. And you are with one of the best organizations in the world, that is Carrick Wealth, sitting locally in Zambia, headed up by Carmen and her wonderful team. Carmen, I hope that helps you. I hope it gives a good overview of how a universal life works, and also a bit about a background of how Continental works and how we can support you. And if you have any questions, I'm very happy to answer these. Over to you.
Thank you, Richard. Yeah, the presentation was quite clear. We do not have any questions from the audience at this moment. Give me a second. Okay. If there are no questions, Richard, is there anything else you'd like to highlight?
No, I think other than to say the best time to start these plans was yesterday. It's amazing how many people overlook the importance of insurance, and sadly, for some people, until it's too late. But protection is the most important aspect of the financial planning process. In the UK, for example, part of the process when I was a wealth manager for Lloyds Bank, if you hadn't addressed the protection aspect for a client before the investment aspect, it wasn't allowed to go ahead. You had to address the life bit. We just want to make sure that, as per the picture, that people can have fun, carry on with their lives. And this is a great way to do it, but get your money back. But Carmen, thank you so much for inviting me today. Greatly appreciate it. I know you've got lots of key providers that you work with, and we're very thrilled and proud to be working with you.
You're welcome, Richard, and thank you so much for taking the time to speak to our Zambian and African clients and let them know about the opportunity that exists in being able to have a dollar-based life cover that would offer protection as well as an investment that they can tap into in the future. We definitely will be getting in touch with you for those quotations as we speak to the client. And for our audience, we'd like to thank you very much for taking the time to listen to this presentation, and we hope that it's been fruitful for you. My team and I will be in touch with you to take the conversation forward. So we've come to the end of today's webinar. Thank you. Thank you so much, Richard.
Thank you very much. Take care, everyone. Enjoy the rest of your day and your weekend ahead. Bye for now.
Thank you.